Hello, everyone. I'm Ted Oakley, managing partner at Oxbow. And my pleasure again to have Ivy Zelman back with us because Ivy is, she's top of the mark. There's nobody better than Ivy in her field of real estate research. But she's CEO of Zelman Associates. And Ivy, glad to have you back.
Thanks for having me, Ted.
Yeah.
I wish things were a little better out there. I'm sure we'll get into that, but appreciate the opportunity. Good to see you.
Well, I thought you have some interesting points to start out with, and I thought we'd get right into it about how much payments are going up, what's going on in all the different markets. So I'll let you have it from there.
Sure. Well, obviously everyone is very concerned about the lack of affordability in the market, but with October's surge in rates, which of course they've now since pulled back quite a bit, if we just looked at the October timeframe, year over year monthly payments for a new home were up over 60%. So the monthly payment has soared, and that's had a tremendous negative impact on the overall new home market, existing market, and people are optimistic with the cooler than expected CPI print and PPI being cooler and the bond market having a historic rally again, seeing the 10-year come back down, that maybe that will reignite demand and we'll see that affordability improves. For every 25 basis point change in mortgage rates, that equates to a 3% reduction on average in the monthly payment. So it has still a ways to go to get back to even what would be normalized. We'll get into that later when we talk about mortgages, but generally for new home, it's certainly having a negative impact.
Well, and you might get into basically what we're seeing in the new home market, new housing market.
Sure. Well, you may recall, Ted, that we do a proprietary survey of private home builders, which is one of many surveys that we do for each of our silos within the housing ecosystem. It equates to about 15 to 20% of the new home market, which compares, just to give a framework, to the public companies that are roughly 50%. So it's highly correlated, 95% to the public's very good leading indicator to know what's going to happen quarterly. And I would say that October just plunged. Year over year, orders were down 46%. And I think if you look at that geographically, it's much more skewed to the West. So the West is down over 80%, and we are seeing the most pain in the Western Western markets in the country.
And do you see the same thing in the multifamily, or is that holding its own?
Well, multifamily is holding its own to the extent that we're not seeing pricing coming down. We are seeing sequentially pricing decelerate on new move-in certain parts of the country where supply is much more pronounced, which I didn't really get into in the graphs that I provided you, but multifamily is at an all-time record high in terms of the backlog. And a lot of that backlog has just been unable to get completed, supply chain bottlenecks. But as those markets in the West have the most supply for multifamily, I think we will see lease price pressure. Right now we're seeing deceleration in new move-ins. I was out in Seattle last week, and new move-in rents are kind of flattish, and that is down from a double-digit pace. So we're seeing an impact, but not to the same extent. The transaction market is at a complete standstill, and that is a result of the cost of capital and uncertainty and volatility. That price discovery, where we're seeing it, could be down 15, 20% for the not the best-in-class asset and location.
Ivy, a lot of talk about the last couple of years about supply, not enough supply. What are you seeing relative to that as far as the spec market?
Well, I'm glad you mentioned that. And if you look at your slides that I provided you, the spec inventory for the new home market is pretty close to record highs. That's really the challenge, is supply in many markets that is already in backlog, that speculative needs to be moved. And we just saw housing starts come out today. While housing starts and housing permits are down about 20% nationally, what you're seeing is a continuation of builders that are starting homes without a contract, without a build to order, because they're trying to mitigate the inflation that they're seeing in material costs. And they also believe that consumers would prefer to buy move-in ready. And so there's that really delineation between builders that are doing just build to order versus spec, but the spec levels are extremely high. If we work through those spec levels and starts pull back, and we work through the overall backlog, because backlog is pretty close in total, including the build-to-order contracts, to 2006 highs. Some people are optimistic, including us, that we could clear the inventory probably after the first half of 23 and start to see a little bit of relief on the pressure that we're seeing in the market.
Are you still seeing incentives high?
Incentives are just skyrocketing, and I think that the soup du jour is mortgage rate buy down. So builders are basically providing consumers and paying for every point they get the rate down. It's a direct hit to gross margin right now. So we're looking at 4.99% 30-year fixed, and some builders are taking a hit as much as 800 basis point on margin to offer the consumer that discount. And of course, other discounts, options, upgrade, closings, but there are outright base cuts that we're seeing now. And builders are actually going to backlog proactively in some cases and trying to protect the backlog from canceling by providing those consumers similar prices that are in backlog. And sometimes it's a risk because it could spook the consumer and they cancel. And cancellation rates have been also surging. And we can talk about that if you'd like, but that's a big concern in the market.
Well, a question for you: in your career, have you seen incentives higher than they are now, or are they about as high as they ever were?
Well, utilizing our historic tracking this data, we only go back to really when we started Zelman, but I could tell you that we were seeing a lot more pressure later within the downturn. So at first, there was a reluctancy to really provide the kind of incentives. So the trajectory has been steeper than we've ever seen in most metrics. So in other words, the rate of change has just been so much faster in terms of the market turning. And we attribute that to really the fact that we had the great financial crisis and people learned their lesson that they're not going to stick around and they're going to move the inventory. So I think that the magnitude is probably more pronounced today in rate of change, but in absolutes, I'd say that it was probably more significant in GFC.
So are you starting to see that in the pricing generally all across the board?
Absolutely. Depending on the market, obviously there's regional discrepancies and more pressure in some markets than others. But based on our survey for October, we're looking at seasonally adjusted annualized price declines of about 12% nationally. And that just assumes that if the market doesn't improve or deteriorate further, it would stay at roughly down 12. And I think that we're biased to the downside, just looking at what we're seeing today. But again, market could start to, which will frustrate the Fed if the mortgage rates pulling back creates sort of a improvement in demand. But right now, I'd say that October was the worst month of the downturn so far.
Well, if you had to guess, I know it's hard to obviously know this number, but if you had to estimate how far we're into that, like a third into it, a half into it, what would be your thought process?
I think that, by the way, just to clarify, is net overall price declines, seasonally adjusted, which you therefore include incentives and outright base cuts, which it's more been pronounced on incentives. So I think there are markets just thinking out west where we're seeing just outright price declines 15, 20%. So if we don't see any type of improvement in the economy and rates are stubbornly higher than, call it, 6%, I think you're going to see pricing continue to decline, could be down nationally in the magnitude of 20%. And that's really just giving you sort of some perspective, but you've got many markets that just don't have the supply pressures. So if you're in the Midwest or you're in the Northeast where supply is so constrained, you'll probably see those markets are more in the mid-singles. I don't expect them to deteriorate as much. But I do think that that's also, Ted, contingent on how the economy holds up. And we both know that if the Fed can orchestrate a soft landing, which is, would be a miracle if they could pull it off, then the price declines will probably start to stabilize.
Well, what do you see builders generally doing as far as taking down lots? I mean, where are they on that?
I think that they're pulling back on their option contracts, or they're walking away. Option abandonments are become more pronounced, really on a relative basis, pretty modest today. But they're renegotiating every land deal. And I think that the land sellers are working with them, but I think they still have a longer term view that there's a deficit in the United States of housing supply and a need for more shelter. So I do think that they're not walking away as much as they're renegotiating, but we are starting to see a moderation in land pricing, still inflating double digits, but not anywhere near the rate that we've been seeing. And land sellers haven't really gotten the memo, Ted. They're really not yet. It's pretty sticky on the way down, pretty fast on the way up. But we would expect that the land sellers will start to capitulate.
You know, it's interesting you say that. I've talked to a couple of people that just do the development side, and they're almost a little arrogant on the fact that that won't affect us. We're not going that direction. And I'm thinking, well, what about demand?
Well, part of it too is development costs. If you look at the industry in total, whether it be multifamily or singles, we're talking about sewers, roads, and pipes, probably up 30%. So in order for them to cover their costs and get to their return hurdles, that's really part of the challenge for them. And impact fees, which are the fees that local governments charge developers, have soared. So their costs have inflated and they're just trying to keep up. So for them to give back price to builders makes their return profile not as attractive. And I think that's really what's driving their decision to be stickier. But they're going to have no choice, to your point. If demand is rolling over, then you're going to see at some point they're going to have to be willing, if they want to get absorption on that land, to be more more willing to negotiate.
Are you hearing that the banks are putting pressure on the independents as far as the land developers, or we haven't gotten to that point yet?
Well, I know that the banks have pulled back and are much more stringent, requiring more equity. Their terms have tightened. So I think it's today, from just looking at the construction side, we definitely are seeing tightening. And on the acquisition development side, that tightening is also prevalent, but I don't know how much further they'll tighten. But there's more cautiousness in the air, for sure.
And are you still seeing in this same arena, are you still seeing the bill for rent leading the charge? I mean, last time I talked to you, they were big.
Well, and the appetite certainly had soared over the past 2 years, and what we've seen now is a bit of that appetite waning. But our expectation is that build for rent will continue, but at a value. So housing starts for the U.S., we anticipate starts will decline in the production side of the business about 25% peak to trough. Now, if you look at what the benefit of build for rent means, though, on the non-production start side, we are seeing double-digit growth. So in total, our housing start forecast troughs around under 1 million, about 935,000 units, which is really be due to the benefit of offsetting production starts with build for rent starts. So if you look at the percent of starts, which just came out, while 3Q actually did pull back 6.6% of total starts in the United States, are, at least based on the Census Bureau data, are showing that they are purposely starting for rental purposes. But keep in mind, many builders are selling scattered lots, and they didn't denote through that start that they were going to sell it as a build for rent shelter. And alternatively, they're selling whole communities in some cases. And if it wasn't for build for rent, I mentioned earlier, Ted, it's a little startling that the overall orders were down 46%. We have, through the survey, aggregated that about 20% of their orders are coming from build for rent operators acquiring lots from them, which that I believe is understated. I think it's closer to 30 to 40%. So they're fortunate if the build for rent operators are, and what just to elaborate, the build for rent operators are willing to buy but want a discount, whether it's 500 basis points below what they would get for a gross margin for a build to order. They're willing to give that pricing to them because they also don't have marketing and sales costs, customer acquisition costs. So for them, our gross margins are so high, we have a flexibility, we can work with them, but it's been, a fortunate distribution channel for the production builders that are built for sale operators.
So if I move on to existing home sales, and it seems to us at least, there's a barbell effect of the mortgage where one end has a 3 and the new one has a 7, and there's not much in between necessarily. But talk a little bit about how those mortgage rates have affected existing.
It's been, again, as the new home market has also experienced, the prevailing rate, if you look at the correlation to existing home sales, the overall correlation extremely tight going back historically. So as the prevailing rate accelerates versus outstanding, existing home sales decline in the same direction. And so what we saw really from the beginning of the year relative to where we were, in the first 7-9 months, we're down, call it in 7 months, the magnitude of the decline it took 26 months for the Great Recession to have the same magnitude of decline. So it really has been fast and furious. And I might have gotten that wrong. Let me just double check. I think, it's taken, to get to the cumulative decline of 27% that we saw for the first 9 months of 22, that took 19 months from the peak in 05 during that same time frame to get there, that magnitude. So it's been much swifter, and I certainly would say that trajectory is continuing downward decline. Existing home sales, while they're reflective of closings, looking at pending, we continue to see pressure in some markets down 40-50%. Some of the other markets, Miami was highlighted as very, very weak market, surprisingly, down 50% for pending contracts. So it's definitely accelerating to the downside.
And so I'm not certain what the normal resale level is, but whatever it is, I'm assuming, this is a question for you, that it would decline on this rise in interest rate, that resale turnover would go down some. I don't know what the average has been historically, but...
Yeah, and that's absolutely what's happening. If you look at a trend line historically, you're looking at about historically in the 4 to 5% range. And currently, I'd say we're around 4. We got as high during this cycle as 5.4% of turnover. But if you drew a trend line and you said, okay, we're kind of at 4-ish now, what's the downside case? And in prior recessions, we got to 3.3 in the 1991 downturn and the GFC. So if we just said, okay, let's look at a bear case, what would that bear case look like? And we'd say that'd be about another 20% decline in overall existing home sales from current levels, just to give you a framework. So I think it's important to appreciate that part of why we've seen such a swift decline is the velocity of existing home transactions was really, in our opinion, driven incrementally by non-primary buyers. And that has slowed materially. So second home purchasers, dual homeowners, institutional investors are all have pulled back fairly substantially. So that's creating the incremental pressure because that capital is a little bit more savvy. And they're just, looking at rates and cost of capital, and that's adding to the pressure that we're seeing.
Well, if you look at affordability in that same vein, what does that payment have to get to before I'll use the payment because it seems like everything works on the payment, but what does it have to get to before we pick it, get it back up again? As the business itself.
It's tough to say. When mortgage rates were 5%, affordability was still, the monthly payment was still above historic averages. And I think that around 4% 30-year fixed, if you were holding the other variables constant, because keep in mind, you've got wage inflation, you also have home price inflation. So the three variables, it's tough to nail just what rates do, but we would need to see a pretty substantial decline in price to get back to sort of normalized affordability, probably in about the 20% range in order to get to a trend line. But I do anticipate one of the biggest challenge in the market is the fact that, you've got over 90% of homeowners in the United States are locked in below 5, not at 5, and almost 50% locked in below 3.5. So we call it the stuck factor. And mobility, which had been surging as a result of the COVID, with people, benefiting from, remote work opportunities and, fleeing dense markets, We're already starting to see mobility through post office data show that it's decelerated back to pre-COVID levels for the top 15 destination markets. So people requesting an address change. And I think, therefore, there's more of a normalization that's coming to fruition on that. I do think that affordability for a lot of second homeowners and investors wasn't driving the market. It was the cost of capital for them, which has also skyrocketed. So you've got the dynamics of, if investors don't step back in, that you need to see probably even higher levels of affordability to attract. The psychological impact is weighing on people. One of our builders' cancellation rates, I mentioned, had surged. Our survey showed a 25% increase in cancellations in the West, in the overall West, we'll call it Nevada, California, Arizona, like 50% cancellation rates. And I think that builders are citing that half of that is from just cold feet versus affordability. So this isn't just affordability, it's people that are hesitant to buying homes at peak pricing.
Because, I think I'm right on this, you would know, but I believe a week or two ago, D.R. Horton said that their cancellation rate was like 35%.
Well, their cancellation rate was only about 15%. And that was really, I think, they're managing the backlog and, again, protecting the consumers that are locked in. But I do think they've done a better job. They're national, as opposed to some of the builders that are more skewed to Western markets. But in general, I think they did a better job than their peers as it relates to managing cans.
Well, you've been through a lot of ups and downs in watching builders through various economic situations.
Yes.
You see us losing some builders this time around, like we've always done in the past during bad economic times?
I think losing is more unlikely, because I think that the balance sheets have been just flushed with cash. If we're thinking through, rather than use the word losing, consolidation, because of the cost of lots, because the cost of materials, the shortage of labor, and thinking about our aging population, and many of these private builders are sort of like, I've had a good run. So I think you'll see more transactions, and might be at not their peak valuations, but it's just tough to operate out there. And, they've been enjoying, even the private guys, record gross margins, and have tremendous cash on their balance sheets today. So they're in pretty good shape. They learn their lessons too. So I don't see failures outright. Now, of course, you tell me that the economy tanks further and, things were to change, but I think there's been more prudent behavior by the builder community this cycle.
Well, and I know a lot of banks, and having been involved myself, that they looked outside the balance sheet as opposed to just the builder, like you said, as opposed to just the builder themselves. So just to wrap it up, I had two questions to wrap up with you. If you just had, I'll take residential first. If you had to just estimate what you think you're going to be seeing the next 6 to 12 months, what does it look like?
I would say a bit of a continuation of what we're seeing. We don't expect a GFC. We certainly recognize that there's regional differences, and I think it's all about that spec inventory. So I think it's going to get worse as you get into the seasonally slower periods, and builders are working through that backlog. So you see more pricing pressure, acceleration, and probably more of a stabilization at where kind of we bottom out by the end of the first half of 23, barring no major changes in the economy. So I think it's then going to just be a slug. And part of that goes back to, somewhat of a contingency too, on how much of the non or primary demand remains on the sidelines. And if the cost of capital is still elevated, I think it's going to be sequentially a tougher 23 overall, but I think it will be a bit of a tale of two halves, because starts will have pulled back, and we'll start to see less inventory pressuring price.
And the last question I'd have for you would be on multifamily. And everywhere I go, every city, they're still coming out of the ground. They're framing up right now, and I'm thinking, well, when does that peak out, or does it peak out? I guess that's my question to you.
The completions have been very benign, and a lot of that, whether it was high rise, whether it's finding the right labor, getting materials. So it's been surprisingly weak relative to starts. We've been surprised on the magnitude of continued permits and starts, because recognizing that, there's no question that what you hear in the market is that developers are pulling back substantially. But as I told you, the backlog is at record levels, so that it's going to get done over. I try to ask operators to differentiate, the developer operator who they would say, well, we're not starting as much. I said, right, but once you've started it and once you've put, capital in the ground, you're going to continue. And they said sometimes we put those deals on hold. We just delay them. So that's one of the question marks that will determine how much pressure we get from all the supply that's, currently built up in backlog.
Well, listen, Ivy, it's been great to have you on again, and I would recommend your service to so many people out there, not only professionals, but anybody else that really wants to know what's going on in the industry. You're certainly top of the mark in your business. I want to thank you for being with us today.
Well, thanks for having me, Ted, and happy holidays to everyone.
Same to you. We'll hope to see you next year.
Okay, take care.
You bet. Bye.